Hey guys, welcome to the Procket YouTube channel. If you like our content, please feel free to subscribe to our channel. Watch this entire video, and if you like this, please click on the like button. You can also click on the bell icon to get a notification whenever we upload a new video. In this explainer video, we will talk about various stages of funding rounds which each startup has to go through in its life cycle. At first, raising funds is one of the most critical aspects for a startup. If there's no money, that means there's no business. Let's say you have an idea ready on the whiteboard, but now what? What are you going to do? How will you gather money? But let's say even if you have raised money, it's important to understand the stage of your venture. This will help you evaluate the various risks associated with it. And as you might be aware, there are thousands of private equity and venture capitalists in the world, and each one of the private equity and venture capital have their own ideology, have their own focus areas, and have their own sector restriction. So understanding these funding rounds will also help you identify the relevant private equity funds and venture capitalists to approach. Let's begin this video by understanding what are the different stages of funding rounds after all. So as we just mentioned, this is nothing but a term given to the stage of funding raised by a startup in its life cycle. These stages are broadly divided into bootstrapping, seed funding, Series A, Series B, Series C, Series D, and finally an IPO. Stages essentially represent the growth story of a startup, but do remember that all these series of funding rounds do not occur in all the startups. It's not a written law that always a seed funding should result in Series A and a Series A should result in Series B. And many times you will notice that a startup will not raise all the series of funds. And many times you will notice that a startup will raise the same series of funds multiple times. Going forward, we will discuss each of these stages briefly. We all get ideas, that's very normal. But the first stage, which is bootstrapping, is a stage when your idea is ready to get off the drawing board. Now it is time for you to test the viability of your product. To do that, you need money. At this stage, the only alternative you have are your personal savings, the money lying with your family and your friends. Always remember that nobody will put money in your business unless you have proven that a market exists for your product and it's commercially viable. Also, at a bootstrapping stage, do not expect any valuation upside from your investors. If you are just kicking off from your idea, don't put forth a valuation of $1 million or $1 billion before your friends and family. So the next stage is seed funding. This is where the action begins. As the name suggests, seed funding is similar to sowing a seed for a plant. Most of the startups fail because of their inability to raise seed money. At the same time, please be mindful that it involves a lot of risk for the investor. So try to ensure that your idea has some solid foundations to convince the investor. The sources of funds at this stage again includes your friends and family. You can also try your luck with some external investors, typically known as angel investors and angel funds. You can also approach the co-founders of other startups. There are also some crowdfunding websites which allow you to raise funds from several investors at once. You can try uploading your concept in such websites to get some investors on board. This is the stage when your venture actually ignites and gets into business. All of the stage before this is basically more or less an experiment. The next stage is Series A. At this stage, it is expected that your venture should have a fully developed product and a decent customer base. Once you realize that you might reach this stage, sooner or later you should start attending startup events and networking with venture capitalists for potential partnership. You don't want to be in a situation where you actually need money and then you start networking with people. The next stage is Series B. Series B kicks in when you have a proven market base and most likely have a steady revenue stream. You will approach investors for Series B for expanding your market reach and customer base. For example, you're currently operating in the northern part of India and you want to expand to the south. Series B will be your right solution. The next stage is Series C. Series C will arrive at a stage when your venture is almost mature and sustainably operates, which means that you have a steady cash flow and you have sufficient revenues to operate your company sustainably for a foreseeable future. You will typically raise Series C for the purpose of entering into a different product or market. For example, you are an online store selling electronics, but you want to expand into groceries. Series C will be your right answer, because entering into a new market will require a lot of money, and this will be almost equivalent to building a business from zero. Also, sometimes you may want to expand into another sector through an acquisition of a smaller company operating in that sector. If you want to do such acquisitions, it will require a lot of money, and that's when Series C will provide the required fuel. Series D is almost similar to Series C. Series D will occur only when you have not achieved the objectives which you intended to achieve with Series C. Typically, the investors who have participated in Series C will normally be the same for Series D. The last stage of funding round is the IPO. An IPO involves listing your equity shares on the stock exchange. Please remember that not all companies are listed on the stock exchange, and it's not mandatory. Several companies continue to do well without listing on the stock exchange. The objective of an IPO can be twofold. One, raising money from the public at large by providing them an option to participate in your company as a shareholder. And two, providing an exit opportunity to your existing investor. While raising money from the public can be cheaper, at the same time, it is not necessary that your venture will be subscribed or will be liked by the public. So you will have to carry that risk. That's the end of our video. Hope you liked our content. To support you further, we will be happy to answer your specific questions. Please feel free to drop your query in the email address provided in the description below. You can also add a comment. We'll respond to your query as soon as possible. If you liked our content, please give us a thumbs up. Please subscribe to our channel to see more startup related content.